Welcome to the evolving world of finance, where digital currencies are reshaping our understanding of money and transactions. In this era of rapid technological advancement, digital currencies have emerged as a pivotal innovation, challenging traditional financial systems and introducing new ways of exchanging value. Initially popularized by cryptocurrencies like Bitcoin and Ethereum, which brought the idea of decentralized, blockchain-based digital assets to the forefront, digital currencies have now taken a new turn with the advent of Central Bank Digital Currencies, CBDCs. CBDCs represent a groundbreaking step by central banks around the world to modernize financial systems for the digital age. Unlike cryptocurrencies, which operate independently of traditional financial institutions, CBDCs are digital forms of a country's fiat currency, issued and regulated by its central bank. This new form of digital currency aims to blend the convenience and security of digital assets with the regulated, stable nature of traditional money. In this comprehensive exploration, we will delve into the concept of CBDCs, contrasting them with cryptocurrencies to understand their unique attributes. We'll examine how various countries are implementing CBDCs, their potential impacts on the global economy, and the challenges they face. Join us as we navigate through this exciting and transformative landscape of digital finance. Central Bank Digital Currencies, or CBDCs, mark a significant evolution in the world of monetary systems. By definition, a CBDC is a digital form of a country's fiat currency, issued and regulated by its central bank. It's akin to digital money that, while existing in a virtual form, is backed by the government just like traditional currency notes and coins. However, unlike the decentralized nature of cryptocurrencies, CBDCs are centralized, and their value is not subject to the market dynamics that influence crypto assets. The concept of CBDCs isn't just a response to the rise of cryptocurrencies, it's a part of a broader historical shift towards digital financial systems. The journey towards digital currencies began with the increasing digitization of financial services, which paved the way for electronic transactions, online banking, and mobile payment platforms. The advent of blockchain technology and cryptocurrencies further accelerated this trend, highlighting the potential for entirely digital monetary systems. Central banks, recognizing the efficiency, speed, and security offered by digital transactions, began exploring the idea of issuing their own digital currencies. The rationale behind the development of CBDCs is multifaceted. One of the primary drivers is the desire to improve the efficiency of payment systems and reduce the costs associated with printing, distributing, and maintaining physical cash. Additionally, CBDCs aim to enhance financial inclusion by providing accessible digital payment options to those who are underserved by traditional banking systems. In the wake of the digital revolution, they also present an opportunity for central banks to regain control and oversight in a financial landscape increasingly influenced by decentralized cryptocurrencies. CBDCs can be broadly categorized into two types: retail and wholesale. Retail CBDCs are designed for public use, similar to physical cash. They aim to provide a safe, accessible, and efficient means of payment for everyday transactions. This form of CBDC could revolutionize how consumers interact with money, offering a digital alternative to cash and bank deposits, with the potential to integrate seamlessly into existing digital payment ecosystems. Wholesale CBDCs, on the other hand, are restricted for use by financial institutions that hold reserve deposits with a central bank. These are primarily used for interbank payments and financial settlements. Wholesale CBDCs could significantly enhance the efficiency and security of financial transactions between banks, streamline cross-border payments, and even improve the implementation of monetary policy. Each type of CBDC comes with its own set of design choices, technical considerations, and policy implications. For instance, retail CBDCs require careful consideration of privacy issues, user authentication methods, and the potential impact on commercial banks. Wholesale CBDCs, meanwhile, involve complex decisions about the architecture of interbank payment systems and the integration with existing financial infrastructures. CBDCs represent a significant step in the evolution of money. They combine the credibility and stability of traditional fiat currencies with the efficiency and innovation of digital technology. As we witness more central banks exploring and experimenting with CBDCs, these digital currencies hold the promise of transforming the global financial landscape, making it more inclusive, efficient, and secure. In the digital finance realm, Central Bank Digital Currencies, CBDCs, and cryptocurrencies represent two divergent paths. While both are digital currencies, their underlying principles, operations, and purposes exhibit stark differences. Foundational differences. Cryptocurrencies like Bitcoin and Ethereum emerged as a response to the 2008 financial crisis, proposing a decentralized financial system free from governmental or institutional control. They are typically based on blockchain technology, a distributed ledger that records all transactions across a network of computers. This decentralization is a defining characteristic, ensuring that no single entity has control over the currency's network, promoting a form of financial democracy. CBDCs, however, are the digital equivalent of a nation's fiat currency and are centralized, issued, and regulated by a country's central bank. This centralization means the issuing authority controls the supply and can enforce regulatory standards, unlike the typically unregulated nature of cryptocurrencies. Underlying technology. While some CBDCs utilize blockchain technology, it's not a universal characteristic. Cryptocurrencies rely on blockchain to secure transactions and create transparency in a trustless environment. CBDCs, on the other hand, may use various technologies, blockchain being just one option. The choice depends on the objectives set by the central bank, such as scalability, security, and integration with existing financial infrastructures. Control and regulation. Cryptocurrencies operate in a largely unregulated space, with their value driven by market demand and investor sentiment. They offer anonymity and are not tied to any specific country or regulatory framework. This lack of control can lead to high volatility and risks such as fraudulent activities and market manipulation. CBDCs, conversely, are regulated digital currencies, designed to complement or replace traditional fiat. Being under the aegis of a central bank, CBDCs adhere to monetary policy and regulatory standards, aiming to provide a safer and more stable digital currency alternative. This regulatory framework can mitigate risks associated with volatility and illicit activities, but it also means that users of CBDCs may not have the same level of privacy as with cryptocurrencies. Purpose and utility. The purpose of cryptocurrencies extends beyond just being a medium of exchange. They are often seen as a store of value or an investment asset, akin to digital gold. Cryptocurrencies also seek to empower users by providing a decentralized financial system, free from traditional banking and governmental constraints. CBDCs, in contrast, are primarily designed to enhance the efficiency of payment systems and financial services. They are intended to represent a digital form of a country's fiat currency, maintaining its value and trust. The aim is to modernize the financial system, making it more accessible and efficient, while maintaining state control and stability. The distinction between CBDCs and cryptocurrencies lies in their fundamental principles and operational frameworks. Cryptocurrencies champion decentralization, operating outside traditional financial systems, while CBDCs represent an evolution of the existing monetary system, retaining centralized control and stability. Both have the potential to coexist in the future financial landscape, serving different needs and purposes in the digital economy. The implementation of Central Bank Digital Currencies, CBDCs, is gaining momentum globally, with numerous countries at various stages of exploration, development, and pilot testing. This global movement towards CBDCs represents a significant shift in the financial landscape, as nations seek to harness the benefits of digital currency technology. Global overview. The approach to CBDC development varies from country to country, reflecting differing economic contexts, objectives, and technological infrastructures. Some countries are in the research and exploratory phase, assessing the feasibility and implications of introducing a CBDC. Others have progressed to developing and testing pilot programs. Countries like China are leading the charge with a digital currency electronic payment (DCEP) system, having conducted extensive trials in major cities. The European Central Bank is exploring a digital euro, aiming to address the increasing digitization of the European economy. In the Bahamas, the sand dollar has already been launched as a digital version of the Bahamian dollar, primarily to promote greater financial inclusion and reduce transaction costs on its archipelago. Case studies. 1. China's digital yuan. Perhaps the most advanced CBDC project, China's digital yuan, is part of the country's broader strategy to digitize its economy and maintain control over its financial systems. 1. The digital yuan has been tested in various scenarios, including retail transactions and cross-border payments, indicating China's ambition to shape the future of digital currencies. 2. The Bahamas Sand Dollar. The Sand Dollar is the world's first fully deployed digital version of a country's fiat currency. 2. Launched in October 2020, it aims to provide more inclusive access to regulated payments and other financial services for the island nation's dispersed population. 3. Sweden's e-krona. Sweden, with one of the lowest cash usage rates globally, is exploring the e-krona. 3. This venture reflects the country's movement towards a cashless society, aiming to provide a state-backed digital currency option as cash usage continues to decline. Challenges and considerations. 1. Technological infrastructure. Developing a robust and scalable technological platform for a CBDC is a significant challenge. 1. It involves ensuring cybersecurity, resilience to cyber attacks, and the ability to handle high volumes of transactions. 2. Financial inclusion. While one of the goals of CBDCs is to promote financial inclusion, there's a risk that a digital divide might exclude those without access to digital technologies. 2. Ensuring that CBDCs are accessible to all segments of the population is crucial. 3. Privacy and security. Balancing the need for privacy with regulatory compliance, such as anti-money laundering measures, is a delicate task. 3. While CBDCs can offer more traceable transactions than cash, it raises concerns about data protection and state surveillance. 4. Impact on banking system. The introduction of CBDCs could disrupt the traditional banking system, affecting how banks operate and manage liquidity. 4. There's a risk that CBDCs might lead to disintermediation of banks if consumers opt to hold their funds in digital form directly with the central bank. 5. International coordination. For cross-border payments, international coordination and standard setting are essential. 5. This includes addressing issues related to exchange rates, transaction costs, and regulatory harmonization. The global landscape of CBDC implementation is diverse and rapidly evolving. While the potential benefits are significant, the challenges in creating a successful, inclusive, and secure CBDC are complex and require careful consideration and planning. The introduction of Central Bank Digital Currencies, CBDCs, carries with it profound implications that ripple across economic, social, and political spheres. The adoption of CBDCs will not only redefine monetary policy and financial stability but also bring about significant changes in the way consumers and businesses interact with money. Economic impacts. 1. Monetary policy. CBDCs offer central banks unprecedented tools for monetary policy implementation. 1. With a digital currency, central banks could directly implement policies such as interest rate changes or quantitative easing, potentially leading to more effective and efficient monetary control. 1. CBDCs could also enable the deployment of unconventional monetary tools like negative interest rates, directly influencing consumer saving and spending behavior. 2. Financial stability. CBDCs could enhance financial stability by providing a secure and risk-free alternative to bank deposits, especially during financial crises. 2. However, they could also pose risks. For instance, in times of financial uncertainty, consumers might rapidly convert bank deposits into CBDCs, potentially destabilizing the banking sector. Social and political implications. 1. Privacy concerns. One of the most debated implications of CBDCs revolves around privacy. 1. While CBDC transactions might offer more traceability than cash, thereby reducing crime and money laundering, this increased surveillance capability raises significant concerns about individual privacy and government overreach. 2. Government surveillance. The possibility of government surveillance and control over financial transactions is a critical issue. 2. The design of CBDC systems will need to balance the need for regulatory compliance against the protection of individual freedoms and rights. Benefits and risks for consumers and businesses. 1. Benefits for consumers. CBDCs promise several advantages for consumers, including faster, cheaper, and more secure transactions. 1. They also offer increased financial inclusion, particularly for unbanked or underbanked populations who may lack access to traditional banking services but can access digital platforms. 2. Risks for consumers. On the flip side, consumers could face risks related to data security and privacy. 2. Additionally, in a scenario where CBDCs completely replace cash, individuals may lose the ability to transact anonymously. 3. Benefits for businesses. For businesses, CBDCs could lead to more efficient payment processes, lower transaction costs, and reduced reliance on physical cash management. 3. They also present opportunities for innovation in the financial sector, with businesses developing new services and products around the CBDC ecosystem. 4. Risks for businesses. The transition to CBDCs could necessitate significant changes to business operations, particularly in financial reporting, compliance, and transaction processing. 4. There's also the potential challenge of adapting to a rapidly changing financial environment and the technology that underpins it. The introduction of CBDCs represents a transformative shift in the financial landscape. While they offer considerable potential for enhancing monetary policy effectiveness, ensuring financial stability, and improving the efficiency of the financial system, they also raise critical questions about privacy, data security, and the role of government in individuals' financial lives. The design and implementation of CBDCs will thus require a careful balance between leveraging their benefits and mitigating their risks, shaping the future of money in the digital age. As we conclude our in-depth exploration of central bank digital currencies, CBDCs, it's clear that these digital assets represent a significant paradigm shift in the financial world. CBDCs, as a centralized and regulated digital representation of a nation's fiat currency, stand in stark contrast to the decentralized nature of cryptocurrencies. They embody an effort by central banks to modernize the financial system for the digital age while retaining control over monetary policy and financial stability. Throughout our discussion, we've seen how CBDCs differ fundamentally from cryptocurrencies in their operation, control, and purpose. While cryptocurrencies operate on a decentralized model, offering financial autonomy and fluctuating value, CBDCs are designed to complement traditional currencies, providing a digital alternative that is stable, regulated, and under the oversight of a nation's central bank. This distinction underlines the divergent approaches to digital finance, each with its own set of benefits and challenges. We've also delved into the global landscape of CBDC implementation, observing various stages of development and deployment across countries. From the pioneering efforts of China's digital yuan to the trailblazing sand dollar of the Bahamas, the movement towards CBDCs is a global phenomenon, each country tailoring its approach to suit its unique economic and social context. The potential impacts of CBDCs are vast and multifaceted. Economically, they promise to revolutionize monetary policy and enhance financial stability. Socially and politically, they raise important questions about privacy and government surveillance. For consumers and businesses, they offer a mixture of benefits and risks, from improved transaction efficiency to challenges in privacy and data security. Looking ahead, the landscape of digital currencies is set for significant evolution with the advent of CBDCs. The role of central banks is undergoing a transformation, as they navigate the complexities of implementing digital currencies that balance innovation with stability, efficiency with privacy, and inclusion with security. As this landscape evolves, it will be fascinating to observe how CBDCs reshape our interactions with money, influencing everything from everyday transactions to the global economy. In essence, CBDCs are not just a new form of currency. They are a harbinger of a new era in finance, signaling a move towards a more digital and interconnected financial ecosystem.